Netflix is cutting hundreds of jobs as it seeks to streamline operations in the face of tougher competition. The streaming giant says it's letting go of 300 people, or about 4% of its workforce. And last month, the company fired 150 employees shortly after reporting that it had lost subscribers for the first time in a decade. Now, under pressure from rivals like Disney and HBO, Netflix says it's also planning to introduce a new ad-supported subscription service to give revenues a boost. The firm is the latest Silicon Valley giant to trim its headcount amid dimming economic prospects. Earlier, carmaker Tesla said it would cut about 3.5% of its staff. Meanwhile, Facebook owner Meta will slow down hiring of new employees. And Twitter says it's considering rescinding job offers that have already been sent out to candidates. Now, for more on the story, let's go to David Madden, market analyst at Equiti Capital in London. Welcome back to the program, David. Now, what's happening in the tech industry? Because if you look at the list of companies that are slowing hiring or cutting their staff, it's a pretty diverse set of business models here. So it seems to be an industry-wide trend. So what's going on?
It certainly is a diverse selection of companies, but the overall theme is that big tech had an absolutely phenomenal run in recent years, and it was really given an extra boost by the pandemic. And it's a classic example of companies that are doing well, overshooting to the upside during the good times, i.e., they're exceptionally busy, they can't hire people fast enough, they can't fill seats quick enough. And then when we do see a cooling off in activity, as you mentioned, in Netflix's most recent quarterly update, they actually saw a loss of subscribership. It's worth pointing out, though, the finer details of that report show that in that quarter, Netflix managed to actually gain subscribers. It was the fact that they essentially exited the market in Russia is what actually swung them into the negative. But nonetheless, the growth rate of new subscribers was significantly lower than previous years. And essentially, there's a feeling that things were overstretched for the tech sector. So that's what's going on with the actual business. What's going on with the share price is a very similar story. A lot of the growth that was achieved by these major tech companies was brought about in an era when interest rates were essentially zero, and it's quite easy to get financing. We're now in a period, particularly in the US, where interest rates are rising, and given what's going on with the US government bond yields, particularly the 10-year yield, it looks as if further rate hikes are on the agenda. And with that, people are now asked, and with that, that's going to drive up the cost of borrowing for these companies, well, for companies across the board, but especially tech companies, because they traditionally have a relatively large amount of debt to fund their rapid expansion. Now that we're seeing possible cost of borrowing going up, tech companies are rethinking their big plans.
David, isn't there a labor shortage in the US? So why don't just tech companies hold on to the talent that they already have, just so they can have them on the payroll once business starts to improve and they can help grow their businesses?
I think the labor shortage is slightly disconnected, or it's more to do with different sectors. From what I gather, the real shortage in labor tends to be at the kind of services end, and also, for example, in the hospitality and the tourism industries, rather than necessarily more, say, specialized IT jobs. What we had was, as a result of the pandemic, a number of people who either found themselves on furlough or found themselves out of work because of the lockdowns. Essentially, a portion of those workers essentially didn't return to the workforce, to the sectors that they were previously in when the economy started to reopen. Perhaps in that time they used the opportunity to reflect on actually what they want to do. Some went on to start their own businesses, some went on to further education, and so on and so forth. So most of the shortages that we have are to do with, say, the service sector. In relation to the job cuts in big tech, this is just purely a method of keeping costs down. When your share price is going through aggressive declines, we've seen examples of, say, Meta, Facebook's owner, or Netflix, have major declines of, say, 25–30% in a day. When you have those sort of aggressive falls, you need to start signaling to the stock market that you're getting your costs are under control. So right now, it's got much more to do with actually signaling to the markets is why they're bringing in job cuts, rather than actually thinking about their staffing issues.
All right, David Madden, market analyst at Equiti Capital. Thank you for joining the show.
Thank you.